All right. Well, good afternoon, everybody. My name is Jason DeBono, Vice President of Newview Trust Company, and thank you for joining us for today's webinar on pros and cons of self-directed IRAs for syndications. Now, I know we're going to talk mostly about real estate syndications, but we're going to talk more in general in terms of syndications as a whole. And so we're going to go through this today in our typical webinar format. If you do have any questions, there should be a button on your screen there, both the chat as well as the Q&A. And if you want to use your keypad there to type in questions, those will show up on my screen. I'll pause for a minute every so often, and we'll get those read aloud. Please feel free to ask as many questions as you'd like. I want to make sure that we cover everything that it is that you came on today to hear. All right. So first things first, and that is we are not attorneys. We're not CPAs. So I know we're talking about syndications today, and you get into a whole nother set of legal requirements and rules as it relates to raising money. We are not going to talk about that portion of it today. We're not schooled or educated, nor are we licensed to offer that sort of information. So please understand, everything that we talk about today is strictly for educational purposes. We are not, nor do we pretend to be, attorneys, CPAs, financial planners, financial advisors. We're going to share some information about why people are using syndications through retirement accounts and why they're more attractive than ever. And we're also going to talk a little bit today about what that process looks like and how does it work for you and your potential investors. Newview Trust, we've been around for a little over 16 years. We hold $1.4 billion of assets inside accounts. We've got over 45 employees that service accounts on a day-to-day basis. We have our home office for our administration team is here in Longwood, Florida, just outside of Orlando. And then we also have a trust and compliance office in Sioux Falls, South Dakota. So we are here, we're available, we're here to service your account. But again, we're not here to tell you what to do or how to do it. That's the self-direction. So if we take a look at what IRAs are out doing today, right, and this hopefully is a little easier for you guys to see on your screen. So if we look at this, mutual funds makes up most, half of about all of the IRAs. So that's straight mutual funds. Right? The other half is invested into what they call other investments. That's non-mutual funds. That can be stocks and bonds and real estate and a variety of things. It's estimated that about 15% of retirement accounts are invested into truly alternative asset classes, meaning they are not a publicly traded stock, bond, or mutual fund. So about 10 to 15% invest outside of the publicly traded security type markets. Right? So what's attractive about IRAs? So when we talk about syndications, one of the things that comes with a syndication is it means you're packaging up an investment, right? An offering. You're using some sort of structure, right? Reg D type structure, 506C, D, B. There's a variety of things well beyond my understanding. But once you have the structure, you need investors. And the way that you go out and find investors differs from offering to offering, and the rules about finding investors differs from offering to offering. But what does stay the same in all offerings is you want people to subscribe to what it is that you're putting out in the marketplace. So as part of that subscription process, your clients have the ability to invest both personally or through their retirement account. Here's why people are attracted to retirement accounts and why retirement account investors are attracted to syndications. So the first thing is IRAs represent long-term money. So most packaged up syndications are considered illiquid. So if we're going to put a syndication together for an apartment complex or for a real estate type transaction, for that to go full cycle, it could be 1 year, 2 years, 3 years, 4 years, 5. Most of these are in the 3 to 7 year range. What's nice about IRAs is it's very easy for me to commit my IRA to a 5-year investment because it's already tied up for 5 years. Whereas if you ask me to take the same amount and pull it out of my personal funds, I may be more apprehensive about putting that money into that deal because I'm going to have to tie up money that could be used for personal expenses or personal needs for 5 years. So it's long-term money. The second thing is it's already liquid. Remember that slide. Most people's retirement money is sitting in mutual funds, stocks, bonds, and the sort. All of that is liquid. It means that I can sell that today and have cash in my account tomorrow. The reason that's important is your investors, if they want to invest $50,000 or $100,000, they may have the net worth personally, but their money may be tied up in other investments that aren't as easily liquidated. So the retirement account makes it a relatively easy place to go and liquidate. Number 3, investors want more. So I, as an individual investor with my personal money, I know that I have access to all the investments that exist out there, both public and private. Yet for my retirement plan, I've always been told, and the companies that have always custodied my retirement account have always told me the only thing that's available to me is public investments, stocks, bonds, mutual funds. So you're talking to an investor base that's eager to get their money into something else. They're wanting to find investments that they can see and touch and feel and understand, because let's face it, no matter how sophisticated you are, I don't think anyone understands how stocks go up and go down as a general rule, right? Next, IRAs represent tax-advantaged money. That means that if I make an investment and it generates return, if I make that return in my IRA, it's tax-deferred or tax-free. If I make that same return in my personal account, it's taxable. And we use this in lots of the presentations that we do, and it's something that we talk about regularly, and it's to help understand the power of tax-deferred growth. If you take $1 and you double it every year for 20 years, if you do that in a taxable account paying 25% per year, you will have $78,000 at the end of 20 years. So $1 becomes $78,000. By all accounts, that's incredible. But if you did that same dollar doubling for 20 years and you eliminated or deferred that 25% tax annually, you have just over $1 million. So when we talk about compound growth and compound earnings and tax-deferred or tax-free growth, it's so powerful because returns can be much better by holding them through an investment vehicle that doesn't require that tax liability. So remember, doubling $1 every year for 20 years is going to give you $78,000 or $1 million, right? One is taxable, one is tax deferred. So you can see clearly how powerful that can be. It's where people have investable funds. There are lots of people that want to make investments. There's lots of people that seek opportunities, but they may not have the capital to do it. There's lots of business owners that have good net worth, but they have all their money tied up in their business. Their IRA may actually represent their only liquid funds that can be earmarked for the long term. And then lastly, there's an opportunity to make a Roth conversion. So we're not going to talk long about this, but your potential investors into your syndication can actually take, if I took a $50,000 IRA that I was going to go put into a syndicated offering, I could convert that $50,000 right before I make that investment to a Roth. Now, I've got to pay tax on that $50,000, so I got to write a check. But if I believe that syndication is going to grow and grow significantly, and maybe that $50,000 turns into $200,000 when it's all said and done 5 or 7 years later, that $200,000 is 100% tax-free to me because I did it in a Roth, right? So big benefit, big opportunity, right? All of these represent reasons why so many syndicators offer the ability for their investors to use retirement money. So key things to understand, right? We talked about all the benefits, but let's talk about some things to be mindful of. Number one, we always like to say, whether you're a syndicator or you're taking on syndicators, the deal must stand on its own. Whether I, as a potential investor, or whether one of your potential investors uses an IRA or not, is secondary to whether or not they want to invest in the offering. They have to like the deal first. If they like the deal, right, then it's a matter of how do I pay for it, and that's where the IRA information may make more sense. But if they don't like the deal or it doesn't stand on its own, then it's probably not right for any investor, whether it be an IRA or personal funds. Number 2, NewView does not assist in selling or promoting your offering. So we are a passive custodian. Anyone out in the marketplace that's a passive custodian that says they're going to help you raise money is misrepresenting what they're allowed to do, or they're violating the very terms of being a self-directed custodian. So when it comes to finding investors, we can help you identify what IRA holders' characteristics are. We can help you understand what the process is, but it's ultimately up to you to identify your investors and talk them through your offering. We are completely passive in that. All legal requirements of your offering still maintain even if the investor uses an IRA. So one of the big ones is, based on your offering type, has to do with general solicitation. So if your fund or offering does not allow you to do any form of general solicitation, it's general solicitation if you ask them for money, regardless of whether the money is the IRA or their personal money. It's simply prohibited. It has nothing to do with IRAs. Those are the solicitation requirements. So make sure that you're getting good legal counsel and setting up the syndication, and make sure you understand where the lines in the sand are around general solicitation, because just because you may be talking to someone about their IRA doesn't mean that you can't be in trouble. I remember many years ago, and there's some new offerings now that do offer some opportunity for some general solicitation. But I remember probably 10 or 12 years ago, you'd open up the newspaper and it would say, offering 15% returns, right? Call me to learn more. And obviously that's somebody that's violating clearly the general solicitation guidelines, because that's going out to the public. They have no way of knowing that those are all accredited investors. The second one is accreditation. If your offering has an accredited investor standard, right, meaning you can only take on a certain number of non-accredited investors, or all your investors must be accredited, it is up to you to ensure that the investor is accredited. Whether they use their IRA or not does not change that requirement. So if you have a client that wants to make an investment and they are not accredited, even if they use their IRA, it's still considered a non-accredited investor. And whether or not you can take that on has to do with your offering. NewView, as custodian, is not responsible to verify whether or not they're accredited. So whatever requirements you have for accreditation, you need to make sure that you adhere to those, IRA or not. UBIT or UDFI may apply. This is not the presentation where we dig deep into UBIT or UDFI, but what this says is, depending on the nature of your offering, there may be a tax triggered even inside the IRA. So I know IRAs are exempt from income tax, but certain offerings can trigger UBIT or UDFI. You need to understand, as you're setting up your syndication with your legal counsel, whether or not it does. If it does, you need to provide adequate disclosure, and you need to make sure that when you produce K-1s to your investors, that you are indicating in the box the amount of UBIT or UDFI. If that's something that you don't want to deal with, don't take IRA investors on, because it comes with the territory. Now, your offering may not have a UBIT or UDFI issue, and this is a moot point. But if it does, make sure you're providing the appropriate disclosure to your clients. So let's talk a little bit about kind of a case study here. So this is David, all right? And David has a few different things that he syndicates, right? A resort property, an apartment complex, and some ATM machines. Now, we use these as examples because they're all over the map. And it gives you an idea that syndication can be both real estate, right? Development, like we'll build something. They can be income. So these are buying apartments that simply produce income. They can be businesses that have nothing to do with real estate. So you can syndicate Putting ATM machines. We've seen syndications of like virtual concierge machines that have been out in the marketplace, and you'll see them at different hotels and other things. So we've seen technologies being licensed out through the form of syndication. If you name it, you can probably syndicate it to do it. But in this case, most of these are 5 to 7 year commitments. There's no requirement on that, but in most cases, that's what we see. This could be a 1 year commitment. It could be a 10-year commitment, right? As long as it's disclosed, that's up to you. One of the things that's kind of unique and interesting about syndications is it allows someone to scale what they do, and it allows someone that doesn't know what exactly, how to make that investment. It allows them to participate. So, for example, an apartment complex. I don't know how to go out and buy an apartment complex, but thankfully there's lots of people that do. And so I can invest alongside those people, so I can find the people that know and understand it, that dedicate time and energy to learn it, that have experience, and it allows them to scale, meaning they can buy more doors or buy bigger complexes or et cetera. And it allows me to passively participate in the returns that those generate without having to be the expert, right? So syndications can really be a nice way for people to participate. We also see people invest with both types of money. So we've seen investors that have put in a $100,000 investment, they'll put half, $50,000, they'll buy half a unit or a unit in their IRA, and they'll buy a unit in their personal account, right? So just because you invest with your IRA, as long as you're a passive investor, doesn't mean your personal money can't be invested either. What do we typically see? Well, we see most syndications do raise money from IRAs, or at least accept IRA investors, and the average is about 15 to 25%. Right? So of the over 14,000 assets that we hold, right, a lot of which are passive syndication deals, roughly 15 to 25% of a particular offering is subscribed by IRAs. So it's still a small number in compared to the total offering, but a big number in terms of money that they were able to access. So I'm going to just pull up here. It looks like a question has come in. Remember, if you do have questions, use the chat or the Q&A section to get those asked. So let's pause here. The question says, can you explain how to convert a regular IRA to a Roth? I'll touch on that again, but we do have actual classes strictly on Roth conversions. But the way that a conversion works is actually very simple. At any time, no matter your income, no matter the time of year, you can take any pre-tax retirement account, so traditional, SEP, simple, 401k, and convert it to a Roth. What's nice is you don't have to convert all of it. Okay? You do not have to convert all of it. You choose the amount. And what's also nice is you can convert assets. So you don't have to liquidate your investments. You just have to have a clear market value at the time of conversion. So if I have a $200,000 traditional IRA sitting in stocks and bonds, and I wanted to move 80 of that to a Roth, I simply open a Roth, direct a custodian to take 80 and move it into my Roth. If I did that today, right, February the 13th, 2020, I would receive a 1099 in January of 2021 for all of my activity in 2020. So in January, that 1099 will tell the IRS as well as me that I have $80,000 that needs to be reported on my tax return. Right? And then what tax I owe is between me and the IRS as it relates to my tax return. So if I have losses or other things that I can use to offset it, great. If not, I got to write a check. But I can take any retirement money that's pre-tax and move it to the Roth. And the beauty is there's no income limit anymore. So everybody's eligible to do this. I can do it right away, or let's assume that I went and made this investment. I took $100,000 and I invested into an apartment complex deal. And 8 months later, right, the fair market value of that, as reported by the sponsor, was $102,000. And I thought, man, this is really starting to get some value, maybe there's a potential sale down the road, or there's some activity coming, or it's starting to lease up now, and I see this kind of hockey stick level return. I could choose to convert that asset to a Roth. So if the market value is $102,000, I report $102,000 just like it was cash on my tax return the following year. How much I owe on that is between me and the IRS. Our job as custodian is not to define your taxes. It's to simply tell the IRS what you did, and then you settle up with the IRS as it relates to tax liability. Another type of syndication we see frequently is a debt fund. Right? So instead of participating in the investment returns, we're actually predefining a return. So one of the things that we see pretty frequently is we see a lot of debt funds, and the syndicator will raise money, right? They'll typically pay out a predetermined rate of return. So in this case, they're paying out 10%. Now remember, just because it's a fixed amount, meaning you know what it is, it doesn't mean it's guaranteed, right? It's never a guarantee in any investment. But that means that I, as the syndicator, owe anyone that invests into my fund 10% annually on however much money they put into the fund. Then I can in turn take that fund and I can go lend it out. So I can have a really good lending business. And there's a few ways I can make money. In this case, I get a 1% fee to manage the overall portfolio. So I take 1% off the top and 2.5 points. So that means if I write a loan and I charge 2.5 points for that loan to get over the finish line, I get to keep that. And I can even structure this where if there's more money, we can increase the payout to 11 or 12%, depending on the returns that people are making. Or I, as the sponsor of this, or the syndicator, can pay out 10%, and if I loan it out at 14%, I keep the spread at 4%, right? That's all done when you set up your syndication, and that's all disclosed to your investors. Don't hide behind the fact that you're making money, right? I want my investors to know I'm going to borrow your money at 10%. You're completely passive. You have no work and effort. I go put in all the work and effort. I find the lender, the borrowers. I generate the loans. I do all the legal work through my legal counsel. And for that, I'm going to charge you 1% on the fund, 2.5 points per loan, and I'm going to keep the difference of any loan proceeds I get over 10%. Okay? Absolutely nothing wrong with that. Everybody can win in that scenario. So the biggest part of this is really educating the consumer, because the consumer may not know how that fund works, so the consumer may not know that their IRA can participate. In a deal like this, when you get money back into the IRA, right, it's all tax advantage. And as the syndicator, it doesn't change anything that you would do with your investor, whether they use personal money or IRA money. So if somebody subscribes with their personal money, when I cut out my checks every month, I mail it to them personally. If they subscribe with their IRA, I mail it to their IRA. It's a pretty straightforward process. So how does it work? Well, setting up a syndication is something that obviously those of you on today's webinar, you guys are going to be the ones that are much smarter about that process than us, right? You're going to determine what is your offering, right? What type of investors are you looking for? How much money are you raising? What type of offering are you going to choose? Do you want something that gives you some general solicitation? Do you want something that can accept some non-accredited investors? Those are all legal questions that should all be addressed with good, competent legal counsel. I would never set up any sort of syndication where you're taking money from people. I would never set that up by downloading some LegalZoom packet off the internet. Because when you start raising money, you start taking other people's money in, you now increase your responsibilities and liability, right? You start having people like the SEC and the Attorney Generals that if something goes wrong, start asking questions. And the last thing you want to do is show them some sort of legal docs that were written on the back of a cocktail napkin, right? It's important. If you can't afford the attorney, you can't afford the deal, right? For those that may be investors or potential investors on the call today, you can learn a lot by the documents. If you pull up documents and you see form fields, right? Fields that are marked off where somebody forgot to change the name to something, that would be a big red flag for me, right? Because that tells me that there is not kind of good, competent legal counsel behind setting this up. So those are things that you can validate to make sure that you're investing right. But once it's set up, you can add that asset to our platform. Now, understand, adding it to our platform does not give you license to go out and tell your investors that NewView has vetted, reviewed, and approved it. What it means is that NewView is committed to be able to hold this asset for potential investors. That means it's administratively feasible. It doesn't mean that we've reviewed it, we've not done due diligence, and we don't allow anyone that we work with to go out and suggest that we do. We have actually turned down assets, and we have taken assets off our platform because we've had clients call that have said, I spoke to Mr. or Mrs. Smith, the investment sponsor, and they told me that you approved my investment. They told me that you guys have already done all the due diligence. So please don't misrepresent the role of an IRA custodian. It's simply to provide passive custody without any sort of review to the underlying investment itself. We just make sure that we can hold it, and we'll provide you the necessary paperwork to make it easier to streamline the process. But your clients still have to understand what they're investing into. Step two, once we have it on our platform, it's up to you to tell the story to potential investors. Make sure that you're telling it to investors you're allowed to tell it to by following the solicitation rules. But the story doesn't change because you take on IRA investors. Remember I said that the syndication needs to stand on its own 2 feet. The story is the story. We're raising money to go build X, to go buy X, because we're going to operate in the assisted living facility, because we're going to, it doesn't matter the reason, but that story is your story to tell. The only bit that IRAs play in that story is simply an understanding, once the investor likes this deal, that using their IRA is simply a way to pay for it, right? And it's a way to hold it in a passive manner and defer or eliminate the taxes and hold it in a long-term vehicle. All benefits of an IRA. Once you have investors that like the story and want to use their IRA, you'll need to provide them with the paperwork that we've given you. It's authorization for us to open their account, transfer the money from their current custodian because they'll need money to make the investment, and authorization for us to actually send the funds to your offering. So there's a checklist of documents that we'll need in that process. Once we get the authorization and the funds from their current custodian, we will send the money to you, most likely to your escrow account, right? And you'll accept that subscription from your investor, right? And you'll provide confirmation back to NewView that it's been accepted. So yes, we do hereby accept, NewView for the benefit of Bill Smith as buying 1 unit in this offering. Typically, that's done with some sort of investment certification. In this process, make sure that IRAs never own life insurance or collectibles. So even in syndications, it can be a little bit of a gray area. So if you're starting a syndication that's going to go out and issue life insurance or buy life insurance contracts, it's definitely going to be in the gray area. If you're setting up a syndication whose primary business is to buy and sell artwork, you probably want to look at whether or not you can take IRAs on. As far as people, if you are the one running the syndication, it's your offering, you stand to benefit and make money off of that deal. Really, you should be very careful, if at all, to accept IRA money from your own account. So if you're the syndicator, you probably shouldn't and can't put your own IRA into the deal, nor can most of your family members or the businesses of those family members. So just be cautious of that. You don't want one of your potential clients, if it's your mom's IRA, to have an issue with the IRS because your mom has now really invested into you, right? And the IRS views that as not being an arm's length transaction. So as long as you're dealing with assets that are not life insurance collectibles and you're dealing with truly passive, unrelated third parties, these rules don't really apply to you. As far as the fee, right? So your clients will pay a fee for us to custody their IRA. Understand that we make no money on the back-end investment. So if this, makes money or loses money, they pay us the same fee. It's $50 to open the account. It's a one-time $95 investment fee for us to go and actually subscribe to your offering, and a flat fee of $295 for that offering annually. So if they put 50, 100, 200, 500, a million, 10 million out of their account into your offering, the fees all stay the same. There's no additional cost because they put more or less money into the offering. All right, let me get to the end here. We do have an IRA guide if you want to text your first and last name to 484848. That's really going to be speaking a lot more to potential investors, but that's a pretty good guide if you want to text that and download that document. It's nice for you to have. I will pause here and take any questions. I haven't seen any additional ones come in, but I'll certainly open the floor up should you have any questions. One thing I'll mention is we talked about UBIT and UDFI pretty early on in the process. If you believe that your offering may have or may be subject to that tax, take a look on the blog section of our website. We have pre-recorded videos from previous webinars we've done, and we have one or two that are about UBIT and UDFI. So an easy way for you to kind of go and get a little bit more information about that. Our team can certainly talk and walk you through that process as well as far as what it is. Let's see if anything has come in. All right, well, at this point, I haven't gotten any additional questions, so I'll use this time to thank you very much for joining us today. Keep an eye on our upcoming schedule. We do a class pretty much every week on a variety of topics. Everything is also streamed over the internet and also hung on the blog section of our website, so I'd encourage you to take a look there for the past events and take a look at our upcoming calendar for what events we have in the future. So thank you very much for joining us all today, and take care.